Hello everybody and welcome to part 2 of our week 5 discussion of liabilities. With this week we're covering long-term liabilities. In part 1 we covered the current or short-term liabilities. Part 2 we're covering long-term liabilities. Specifically we're going to be focusing more heavily on the bonds and the bond payables, the liabilities. We're going to deal with the journal entries in this course and we're going to deal with the concepts. But we're not going to be dealing with pricing, which is taken care of in another module. So we're going to look at the terminology and concepts related to this. So first of all, even though we're not going to talk about how to price the bond, we do need to understand what the price is, and that's given to us in the problem. So we have two main values we need to talk about for a bond. The face value or par value is the stated total value of the bond. When you look at the bond contract, when you look at the actual bond, or if it's electronic, whatever, you'll see a total value of the bond. That's the amount that is eventually going to be paid back to the bondholders at the maturity date. However, that's not always the price that has to be paid right now, today, to buy that bond. That's the difference. The interest payment is calculated by taking this face value or par value and multiplying it by the stated interest rate. Now again, by interest payment, I'm talking about the cash interest payment that's going to be made every 6 months, year, whatever it happens to be. The issue price, on the other hand, is the amount that was actually paid to purchase or invest in that bond to begin with. So in one situation, you may be paying $95,000 to buy a $100,000 bond. So you pay $95,000 now, you'll get $100,000 back later, plus you'll get interest along the way. Or you could pay $105,000 now to get a $100,000 bond. You're only going to get $100,000 back at the end of this bond's life. So the issue price could be more or less than the face value, and it's all going to depend on the difference between the stated interest rate and the market interest rate, or the effective interest rate. So we're going to see the difference, and here we have the two different rates listed. Now, like many things in accounting, there are a few different terms for the same thing. So for the stated rate, this is sometimes called the contract rate or the coupon rate. This is the actual interest rate that's going to be paid by the company to the investors every, again, 6 months or a year. Regardless of how the rate fluctuates in the market, this is the rate that the interest is paid at. It's not the same as interest expense. That's something we'll talk about later. This is the cash interest payment. So again, you multiply this stated rate by the face or par value of the bond to determine the actual amount of cash that's being paid every period. The other interest rate is the market rate, sometimes called the effective rate or the yield. This is the fluctuating average rate paid in the open market for bonds that are similar in risk categories to your bond. So this one fluctuates. The stated rate is locked in, though. That's the difference. We're going to look at the difference between discount bonds and premium bonds. With the discount bond, the selling price or the issue price is less than the face value of the bond. So that buyer is going to be paying less up front to get that bond, but then when they cash it in 10 years, for example, they're going to get paid the higher par value. In this situation, this occurs because the contract rate, the stated rate of interest, is less than the average market rate. So in this situation, whoever bought this bond is getting less interest than other investors would be on their average bonds that are out there in the market right now. This is the reason for the discount. You're getting less interest than everybody else on average, so you're going to be paying less to get this bond. Now the premium bond is the exact opposite. You have to pay more for this bond than what you're going to get back in 10 years, the face value of the bond. Now the reason for this is that the contract rate of interest that is being paid is more than what's in the market at this point in time. So you're buying this bond, you're getting more interest than others are on average, and you had to pay for it to get this quote-unquote good investment. Now I say that specifically, I put that in quotes intentionally, because in reality, whether you buy the discount bond or whether you buy the premium bond, you're going to be in the same overall position. Again, either you paid less up front, but you're getting more interest, or I'm sorry, you paid less up front and you're getting less interest, or you paid more up front and you're getting more interest. The same, if you take everything to present value, if you look at the actual value of all cash flows, it's going to be the same thing. Now, this makes a little more sense when we do talk about pricing the bond, but for now, just trust me that the discount bond and premium bond, from an investor's perspective, neither one is better than the other. It's either you pay more and get more interest, or you pay less and get less interest. A couple other terms we'll talk about: debenture bonds versus mortgage bonds. Debenture bonds are basically unsecured. That's the term here. You're relying on the good faith and credit of that company to pay you back. Now, of course, if they don't, you could certainly get with the other investors, the other creditors of that company, and it might force the company into bankruptcy. You still have a claim against assets in general. You just don't have a claim against a specific asset. So you're further in line in the bankruptcy courts. You'd be further in line in the claimants. Mortgage bonds, on the other hand, also known as secured bonds or collateral bonds, they are secured by a particular asset, and if the company fails to pay, you can easily go through the courts and seize that asset, that specific asset. So you have a much higher rank in the claims. So now I'll talk about another couple terms: term bonds versus serial bonds. Now, term bonds, you could possibly have one bond, you might have multiple, but the idea here is they all have the same maturity length. So you might buy a group of 1-year bonds, or you might buy a group of 5-year bonds or 10-year bonds, whatever they might be. The lump sum is due at the end of the period. Of course, you're going to get interest payments along the way, and the entire principal will be paid at the end. The face value will be paid at the end. With a serial bond, this is a series of bonds. So you're buying a group of bonds, and they all have different maturity periods, different lives. So let's say you have a series of 10 different bonds. One of the bonds might have a 1-year life, the next one has a 2-year life, then a 3-year life, a 4-year life, all the way up to 10 years. The idea here is that it ends up looking more like an installment payment, but in reality it's just 10 different bonds that you're cashing out at 10 different periods of time. So that's the idea of serial bond. It ends up looking like an installment. Another very interesting set of concepts here, terminology: registered bonds versus bearer bonds. We've got a little bit of background on the bearer bonds here. Registered bonds today, in our current economy for actually the past few decades, at least in the United States, every new bond you buy will be a registered bond. This means that the owner of that bond, whoever holds it, is always known. It's always tracked. Who is entitled to the interest, that recipient, is always known. And the sales of the bonds themselves are tracked. Now, of course, there are a lot of entities in the country that would want to know about that. The IRS would be one thing. They want to know if there are any gains or losses on sale of bonds or any investment. Law enforcement would like to know if you are engaging in illicit activities and using that money, for example, to purchase drugs or weapons, things like that. So there are a lot of reasons why bonds are required to be registered now. Several decades ago, prior to 1982, they used to have what were known as bearer bonds. Now, I will say these still exist in other parts of the world, but in the United States, new issuances of bearer bonds are no longer allowed. Now, you may have watched a variety of different movies over the years that have referred to bearer bonds. And, basically it's like cash. It's the same idea as cash, only it's a financial instrument. Whoever physically possesses those bearer bonds has the asset, and they also get the interest. So there's a big risk of theft, first of all, just like cash. If you have a lot of these on hand, somebody steals them, you may not be able to get them back as easily, and the company would be paying interest and principal to that other party. By the way, these are sometimes also known as coupon bonds, and the idea here is that this little illustration doesn't quite show it, But when these bonds are first issued, they actually have coupons attached to the edges of them, and that you clip that, and that's how you get your interest payment. And then you turn in the main part to get your principal amount. So again, there's a concern with tax evasion, illicit activities, and things like that. Going back to the movies, what I was talking about, for example, I think Die Hard had bearer bonds as one of the Die Hard movies. They were stealing bearer bonds. No different than stealing cash or gold. It's the same idea. And there are plenty of other movies out there that have bearer bonds as the instrument used as well. Just adds a little bit of interesting complexity to the theft, I guess. So let's look at some other bond terminology. We have bond indenture, and that is just the contract. Now notice we had debenture, which was an unsecured bond. This is indenture, which is the bond contract. It'll tell you what interest is paid, what the interest rate is, what the face value is, how frequently is interest paid, every quarter, every 6 months, every year. What's the maturity date? When will the entire thing be paid off? The bond indenture will tell you everything. We have a couple of types of bonds, callable bonds. Now, these are callable. Of course, it has nothing to do with the telephone. That's just a little illustration here. But they're callable because the company that issued the bonds has the right to call them back, force them to be returned. Basically, they're paying them off early. They're going to the investor saying, hey, here's your money. Give me the bonds back. Now, the investor certainly will be happy to get the money, but the problem is now they have that money, they have to go find a new investment to invest in. That's particularly concerning if that was a high-interest bond. That investor may have really liked that, and now they have to go take their money and possibly invest in lower-interest investments, depending on how the economy is doing. So again, it's an early payoff or retirement. Generally, the company does this to be able to refinance at a lower rate. And because of the impact it has on the investor, most of these callable bonds have what's known as a call premium, which is basically an early payment penalty. So the investor will at least get something for losing their high interest investment. Now, when they're called back early, this can give rise to a gain or loss on the retirement of that bond, the early retirement of that bond. This is one other topic that we don't cover in this particular class, although there are additional videos I have out on YouTube that go through this topic in more detail. Now, I will admit we're talking about convertible bonds here. This just gave me the excuse to put a picture of one of my favorite cars, a convertible Mustang 1967. This is not mine. It's just an image. I would love to have this, though. But, of course, convertible bonds have nothing to do with convertible automobiles. The idea here is that a convertible bond is one that the bondholder can decide to convert to common stock if they want to, instead of continuing to be a bondholder. Now they'll become part owner, an equity holder, instead of being a creditor. This is at the demand of the bondholder. They have that right. They don't have to exercise that right, though. And they're basically trading a fixed reward so the fixed reward, they're basically trading a fixed reward, which is the locked-in interest, the locked-in principal that they would normally get. They're trading that for increased risk that's paired with the potential for higher rewards. As an investor, which is what they will be becoming, they have risk that they may lose it all. The stock may drop to zero. They'll lose their entire investment. But there's also the potential they'll get more dividends down the road. Maybe the stock market will increase, the value will increase. So there's definitely some potential there as well. So let's talk about financing. We know that companies need to have some sort of financing to start or expand their operations. They have the option of choosing debt financing or equity financing. Debt financing is borrowing money. Equity financing is issuing stock and becoming part owner. The benefits of debt financing is that the company, from a company's perspective I should say, they don't need to share the overall profits with other owners. If it's just the one main owner, in a simple example, and they borrow money, the bank or the bondholders, they're not owners. They're creditors, so the company does not have to share any of their profits with those bondholders. Of course, they have to pay them their interest, but they don't have to share any other profits. It also doesn't impact the current ownership shares. It doesn't dilute those ownership percentages, anything like that. There are no additional owners that control the company. And the one big benefit of debt financing is that you have interest expense versus a dividend. Interest expense is a tax-deductible item, whereas a dividend is not even an expense at all. Dividends for stock, it's not even an expense at all, and it's certainly not tax-deductible. So there's one other benefit that it can go either way. It can be a benefit or a drawback, but the potential benefit is that by borrowing money and using it to generate additional money, you have the chance to have an increased return on equity. Now, later chapters we will cover these ratios, the return on equity and such. But the idea here is if you borrow money for a low interest rate, let's say you borrowed at 4%, and you're investing it at a higher rate, let's say you're investing it at 9%. That's positive financial leverage. You're basically earning 5 additional percentage above and beyond what you had to pay to borrow that money. Now, it's good when it happens that way, but it could just easily go the other way. You're borrowing at 4% and you're only able to generate a 2% return. You're losing money on every dollar borrowed, which is exactly what this drawback is at the very bottom. It's the exact flip side of that. But another drawback of debt financing is that the company has to pay interest payment each period. There's no way of getting out of it. There's a lump sum payment also due at maturity, and that's locked in. You have to pay it. Whereas with stock, you're not absolutely required to pay dividends. The investors may not like it, but you can certainly zero out your dividends. And there's never a time when you finally have to pay the stock off. When the company liquidates, the assets are shared amongst the owners, but there's no set date where you have to pay everything off. So now we're going to go through a few different concepts related to the bonds themselves. First, we're going to talk about the issuance of the bond and what journal entries are related to that. We need to know the price of the bond versus the face value of the bond. And remember, that's all related to the comparison of the two different interest rates. And it's the timing difference between the write-up and the issuance of the bond. That's what generally leads to the difference between these two rates. We lock in a stated rate when we're drawing up that bond contract, but then by the time we get around to selling it, to issuing it, go through all the legal work, the market rate has likely changed. It's very similar. The bond market is very similar to the stock market. It fluctuates on a regular basis, and all of a sudden the rates are higher for those similar types of bonds, or maybe they're lower. It's not quite as volatile as the stock market usually, but it certainly can change. So that may be one reason there's a difference, but there might also be the company intentionally set their rate at a higher or lower rate. In the end, it's not going to help or hurt the investor or the company whether this bond is issued at a discount or premium. It just does not make any difference. It's just the journal entries that'll be a little bit different, but the end value that the investor gets and the company gets is going to be the exact same. And again, that is talked about more when we talk about the pricing of the bonds and we look at a concept called present value, the time value of money. But for now, we're just going to leave it at this level of depth. So when we are recording the journal entry to issue the bond at par, this means that the stated rate and the market rate happen to be one and the same. It's the exact same rate. So we're issuing the bond at par. We're debiting the cash, let's say for $100,000. We're increasing our cash asset. And we're going to credit our bonds payable for that same $100,000 because we owe money. Bonds payable is a liability. Let's say instead we issued this at a discount. We would do this because the interest rate we're paying at is less than what the average market rate is. So the only way we're going to ever attract an investor is if we issue this at a discount. Now in a discount situation, our bonds payable might still be that same $100,000 face value, But depending on how the pricing works out, we may only be receiving $95,000 for this bond. So we'll debit cash for $95,000. Of course, our debits and credits have to balance out. So the extra $5,000 on the debit side goes to an account known as a discount account. Now, what I'm going to say here is that the discount is known as a contra asset or contra liability account. It is offsetting the liability account. We'll see that in just a bit, how this looks on the balance sheet. Anytime you hear the term contra account, note that it has the opposite normal balance of whatever it is contra to. In this case, the discount is contra to the bonds payable. Bonds payable have a normal credit balance. This discount has a normal debit balance. So if we ever want to increase a discount, you debit it, and to decrease it over time, you end up crediting it. But for the journal entry, just note, we're going to debit the discount. Now let's say we are issuing this at a premium instead. We're paying more with a stated rate than everybody else is paying on average through the market rate. Still the same $100,000 credit to bonds payable, but now we're getting more on the cash side, $105,000 instead. The extra $5,000 here would go on the credit side to balance out, and that premium on bonds payable is what's used for that. That's known as an adjunct liability. That's the name of this account. It's the opposite of a discount. It's the opposite of a contra account. An adjunct adds to the liability in this case. So let's see what this means. On the balance sheet, we're going to have our bonds payable. Now, this is not a continued example, but we're going to have a bonds payable amount. And if we have a discount, we would subtract that to get the net carrying value of the bond, $25,000. If we had a premium, we would add that, and we would say $28,000 plus $3,000 would give us $31,000 in that case. So it just depends on which way we're going. So now we're going to deal with the journal entries for the interest expense itself. But before we do that, I have to clarify something. I have to make sure to state this. When we have that premium or discount that we've set up initially, what's going to happen is over time, we're going to have to get rid of that. We have to amortize it or eliminate it over time, if you will, spread it out over time. And so that at the end of this bond's life, we have zero premium or discount left. But when we do amortize this throughout its life, it impacts interest expense. Now, I'm going to give you the rules here, and then we'll see why when we do the journal entry. A premium, when we amortize that throughout its life, that ends up decreasing the interest expense for each journal entry. It'll decrease the interest expense below the actual cash interest paid. A discount is the exact opposite. It will increase the interest expense above the actual cash interest paid. Again, we'll see why in just a bit. And this is the same slide, basically. So we talked about how we have the carrying value of the bond. That's the term we'll use here. It's the issue price plus any unamortized premium and less any unamortized discount. So here we have an example. The bond is sold at $110,000 with a face value of $100,000. The carrying value initially is $110,000, but it will decrease over time as the premium is amortized. Eventually it'll hit $100,000 by the end of this bond's life. If a bond is sold at $90,000 with a face value of $100,000, the carrying value initially is $90,000, but it will increase over time as that discount is amortized until it finally hits the $100,000. Now here's just a very crude example of that. It doesn't match the numbers we were looking at, but we're saying with a premium we start high, work our way down to the face value. With a discount we start low, work our way up to the face value over its life. Now, the method we're going to talk about most in this course is called the straight line method, which means that every single year it's the exact same amount of premium or discount that's being amortized. We talked about how this would look on the balance sheet as well. This is the same example from earlier. So now let's look at the journal entries. We're going to start with the issuance, and then we're going to talk about the interest expense. First, we're dealing with a premium. With a premium, we know that our cash is going to be higher than the bonds payable, so we have to have a premium that we credited. Now, when we do the journal entry for the interest expense, first of all, that premium that we credited, that larger amount of the premium, we have to spread that out over time and debit it to eventually zero it out. We're reducing it to zero it out. Now, the method we're using here, it says it's a 10-year bond, or that's what it is in this case. So we're basically taking this $12,289 and dividing it by 10. So we get $1,229 rounded. We're debiting the premium for that. Now the cash is the amount we're paying. So that's the 10% stated interest rate that we're paying, and it's 10% of the face value, $100,000. So we're going to credit cash because we're actually paying it. We already have one of the debits for the premium. The other debit, the big debit here, is going to be to interest expense, and it's just going to be a plug figure. It's the amount we need to debit so that our total debits and total credits balance out. Now let's take a look at the discount. We started with a discount on the debit side, and then our cash was less than the bonds payable amount. When we do the interest expense entry, we're still crediting the same amount of cash. That didn't change. It's still 10%. But now, since we started with a discount on the debit side, the interest entry has to credit the discount, again, for 1/10 or 10% of that original amount to spread it out over 10 years. So now we have two credits, so we have to have a debit that is large enough to account for both of these credits, $11,229. As we said earlier, amortizing a discount increases the interest expense above and beyond the cash interest paid. That's what we're saying here. Now, the interest expense calculation itself, we have the cash interest calculation. It's the face value multiplied by the stated rate. And then we have a discount or premium amortization. Again, we're just going to take that total amount and divide it by the life of the bond. In this case, 10 years. But I do want to say here, some bonds, many bonds, are semi-annual periods, twice a year, 6 months. In that situation, if you had a 10-year bond that was semi-annual, you would actually need to divide this by 20 periods to get the amount per period, per 6-month period, to amortize. So just keep that in mind as well. Now again, to calculate the interest, it's either the cash interest plus the discount amortization, or it's the cash interest minus the premium amortization, depending on which one you have. So we have two methods that can be used to calculate interest expense and the amortization of the premium and discount. The method we talked about was straight line. That basically means we're spreading that total premium or discount out evenly over the life of the bond. And that also means that we could calculate the cash, we could calculate the discount or premium amortization, and then the interest expense was just a plug figure to balance everything out. The other method, which we don't go into any detail in this class, but I want to mention that it exists, is known as the effective interest method. And in this case, what we're calculating is the interest expense. We're calculating that, and of course we're calculating the cash payment, and then we back into the discount or premium that needs to be amortized. So the way we would calculate interest expense under this method is by taking the carrying value of the bond at that point in time, which I'll show you in the next screenshot. I'll show you what I mean by that. So the carrying value of the bond for that particular period, the beginning of that period, multiplied by our market or effective interest rate. That's where the name comes from. That gives you the interest expense for that year. And because of the nature of this calculation and the fact that our carrying value changes over time, the interest expense every year will change, as will the discount or premium. But of course, the cash is locked in. That's different than our straight line method, where of course the cash payment stays the same, but under the straight line method, since we're spreading out that premium or discount evenly, every year is going to have the same premium, and it's also going to have the same interest expense. Back to what I was saying earlier. This is called an amortization schedule, by the way. It shows how we've amortized the premium or discount and basically what our carrying value is at the end of the periods. Of course, it also shows the beginning of the period as well. And what I wanted to stress is under the effective interest method, this amount for each individual year is what you use to multiply by the market interest rate to determine the interest expense for that year. But again, that only matters under straight line. This is a premium. The unamortized premium starts at the high amount, and obviously over time we use that up, but that premium caused the carrying value to be at a higher amount as well for the bond overall, and eventually after we amortize that premium, we'll get it down to exactly $100,000 at the end of this bond's life. If this was a discount instead, again, our carrying value would start out low, and we'd work our way up to the face value. Now notice there's that extra dollar here. That was just a rounding issue. Normally you would zero that out in that last year. We just went a little bit too far. It's just a rounding variance. But notice here also that the discount itself, it has whatever the balance is, and we're trying to work it down to 0, or in this case it went to -1. Now the last thing I want to mention here, I talked about how pricing is not discussed in this video. There's also one other main concept that's not discussed in this video, but it is in other videos I have on YouTube, and it's the idea of what happens if you sell this bond early or pay it off early. If we waited until the end of year 10, hey, our carrying value is exactly $100,000, and we're going to get $100,000 we're going to give $100,000 by paying this off, so there's no gain or loss. The liability was paid off exactly at that amount. But let's take a look. If we paid this off in year 4, we know we have to pay $100,000 no matter when we pay it. That's the par value. If we pay it off on year 4, the carrying value is only $92,000 because we still have some discount left. So we're going to have a gain or a loss depending on a variety of other things, one of them being that early payment penalty I mentioned earlier. So if you pay it off early, what I want to say is that you may have to record a gain or loss on the retirement of that bond. Now that concept is discussed in much more detail in a later chapter outside of this course, and again, the YouTube videos are available. That takes to the end of our discussion for bonds payable. Hopefully this has helped to clarify some of these concepts. I look forward to talking to you in our later sessions, and have a great week.